In this video, I'm going to give you an overview of the tax rules for S corporations in the US. We'll discuss what an S corporation is, how you'd go about electing S corporation status, requirements to be an S corp, how S corps allocate their income and deductions to shareholders, the tax consequences when an S corp makes a distribution to its shareholders, how to calculate basis for a shareholder in an S corporation, and finally, taxes that in some cases can be imposed on S corporations. Let's get started by talking about a basic question: what is an S corp? So an S corp is a business entity type in the United States that provides the legal protections of a corporation but is taxed as a flow-through entity. So what does that mean, that it's taxed as a flow-through entity? That means that it is not subject to double taxation like a C corporation. Okay, so S corporations, there is just one layer of tax. In short, basically the S corp has some profit, let's say $100,000 of profit, but the S corp itself does not pay tax on that $100,000. It is allocated to the shareholders of the S corporation, and they pay tax on that income on their individual tax returns. Okay, with a C corporation, in contrast, C corporation, there is a tax at the entity level. The C corp pays income tax, and then when it makes a distribution to shareholders, if that's deemed a dividend, they can be taxed on the dividend as well. So you have two layers of tax. With a C corporation and S corporation, you just have one layer of tax. So they're both corporations, right? So an S corp is a type of corporation, so you have limited liability for shareholders, just like you have with a C corp. However, it's a flow-through entity, so the profits of the entity are going to flow through to the individual shareholders and be taxed at the shareholder level. So just one layer of tax. Now, the tax return for an S corporation is Form 1120S. If you remember, for a C corp, it's Form 1120. For an S corp, it's Form 1120S. Okay, but remember, the S corp itself does not pay any income tax. Now, there are a few exceptions where there are taxes that can be levied specifically on S corps, and we'll talk about that at the end of this video. But there's just a single layer of tax. You don't have S corps paying income tax. Now, there are a number of tax advantages to having S corps. I'll make another video where I discuss those, but just one of them is that the profits of the S corp are not subject to self-employment tax. It's a little bit more complicated than that. Basically, if you're a shareholder, you're doing work for the corporation, you have to pay yourself a reasonable salary, and that would be subject to payroll taxes. So I'll talk about that in another video. But there are a number of tax advantages to having an S corp, and there's some disadvantages, which we will discuss later. Now, how do you go about creating an S corp? Well, you need to incorporate in a U.S. state. Okay, so just like a C corporation. And in fact, actually, when you go and incorporate, let's say, for example, you created a corporation in Illinois. Initially, the default status when you create a corporation, so you file your articles of incorporation and so forth, you have a C corporation, and then you need to elect S corporation status, and you make that election with Form 2553. So you have to pick a U.S. state, you need to go create a corporation, file your articles of incorporation and all that, and you initially, as soon as you have that corporation, you have a C corporation, and then you go and make an election to have an S corporation. Okay. Now, not just any company can be an S corporation. There are a number of requirements. Okay. Now, technically, S corporation, so in the code, it refers to a small business corporation. Okay. Now, some people think, okay, well, small business corporation, does that mean really large, like companies that are very profitable or have very high sales or a lot of assets? Does that mean that they do not qualify to be an S corp? Actually, no. Right? So there are no asset or revenue limits or anything for an S corp. So you could have a very profitable company with a lot of sales, a lot of profit, a lot of assets, and they could be an S corp. Okay, but there are a number of other qualifications that need to be met. So there's no asset or revenue limits or anything like that to be an S corp. But the company, to be an S corp, needs to be a domestic corporation, which means it needs to be incorporated in the United States. Okay, now it needs to not be an ineligible corporation. There are some corporations that the code has just said they are ineligible to be an S corp. For example, certain banks and insurance companies have been deemed to be ineligible. Okay, so you can't be an ineligible company. You need to also only have one class of stock. Now, this gets a little tricky because technically you can have two types of common stock. So you could have voting common stock, and then you could have non-voting common stock. And you might be thinking, hey, you just told me you can only have one class of stock. Well, it's okay if you have different types of stock that differ whether they're voting or non-voting. Okay, where they need to be the same is in terms of any distribution preferences. If there was a liquidation of the corporation, they can't have different rights with respect to distribution and liquidation. But you could have voting and non-voting stock. Okay, so one class of stock, you can't have common stock and preferred stock with different distribution and liquidation preferences. Now, you cannot have more than 100 shareholders. However, there's a little exception with that. So family counts as a single shareholder. So if my wife and I were shareholders in an S corp, we would just count as a single shareholder. So we could have 99 random people that are not related to us, and then you have my wife and I, and so that's two of us. So that's technically 101. But because we are just counted as one, because we're part of the same family, then it's 100, so it's okay. Okay, so max 100, but as I said, it's a little sketchy there because with the family, technically you can get around that and have more than 100. Now, a non-resident alien cannot be a shareholder in an S corp. Okay, what is a non-resident alien? It's someone who's not a U.S. citizen. They do not live in the United States. Okay, so if they're not a U.S. citizen, they don't live in the U.S., they cannot be a shareholder in an S corp. Okay, and only individuals and certain types of organizations, I won't go through all the different types of organizations, we'll talk about that in another video, can be shareholders. But basically, here's the takeaway. You cannot have a partnership or a C corp that is a shareholder in an S corp. And the reason being because this would be a way to get around that max of 100 shareholders. If you say, oh, there's a max of 100 shareholders, well, you know what? Actually, we're going to have one of the shareholders be a C corp, and then that C corp will itself have 50,000 shareholders. And so that C corp is one of the shareholders in an S corp, and so then it's like, oh, they kind of violated the spirit of this rule because there's, and so forth. So that's the rationale for that. So not just any entity type can be a shareholder of an S corp. So there's a number of restrictions there on who can and cannot be a shareholder in an S corp. Now, that's why, for example, if you have a company like Microsoft and you say, okay, is that an S corp or is that a C corp? Right? It's going to be a C corp because they have tons of shareholders, right? They're not going to meet this maximum 100 shareholder requirement. So when you see these large publicly traded companies, they need to raise a lot of capital from investment from capital markets. They're generally going to be a C corp, right? Because this max 100 shareholders, that's going to be a problem for them. Okay. Now, when it comes to allocating income and deductions to shareholders, it's going to be done on a pro rata basis. Okay, there are no special allocations. So that's something, if you've watched my videos on partnerships, you know that partnerships allow something called special allocations. Now, what does this mean? This means if you are a 10% shareholder of an S corporation, then the S corporation has some, let's say, depreciation deductions or something, or some tax credits or whatever. You're a 10% shareholder, you'll get 10% of those depreciation deductions, 10% of the tax credits, whatever. You'll have a pro rata share. It's based on your ownership share. Okay, you cannot say like what. So with partnerships, you could have a partnership, and you could have one of the entities in the partnership. They maybe get 99% of the tax credits, even though they only put up 10% of the capital or something like that. So that's called a special allocation when it comes to partnerships. You can't have that with an S corp. You cannot have a 10% shareholder get 90% of the tax credits with an S corporation, right? It has to be based on their percentage ownership. So that's what I mean by pro rata for income and deductions. Now, remember, you are taxed. If you're a shareholder in an S corp, you're going to be taxed on your share of the profits, whether or not you actually get any cash, whether or not a distribution is made to you. Because remember, it's a single layer of tax. So if the S corp has $100,000 in profit and you're a 10% shareholder, and then so your share is $10,000 of that, you're going to have $10,000 of income flow through to your tax return, even though the S corp might not have actually given you $10,000. Okay, so you're gonna be taxed on your share of the profits. Now we're gonna have separately stated items and non-separately stated items. The S corp is gonna go and lay out these which are separately stated, which items are non-separately stated. I don't want to go into a long thing on this. I'll just give you an example. For example, municipal bond. Any interest from municipal bonds would be that would actually be separately stated. They would lay it out because that's tax exempt at the individual. So the individual shareholder is going to say, okay, here's your share of muni bond interest, basically. Okay, so you'll have these special items that are broken out separately, and then you have some items that aren't broken out separately. They're just lumped together as income. Okay, we'll go into that in more detail in a future video. Now, losses are going to pass through to the shareholders and be deductible at the shareholder level. So if the S corp loses, $200,000, okay, they lose $200,000 and you're a 10% shareholder, you got a $20,000 loss there. Now you need basis, right, to be able to deduct the loss. If you have no basis, you won't be able to deduct it, but it will pass through at the individual level. And that's a difference from a C corp, because with a C corp, you have this loss, and the C corp can carry the loss forward to offset future income, but the shareholders cannot deduct their share of a loss for a C corp, right? But with the S corp, losses pass through to the shareholders. Next, let's talk about the tax consequences of distribution. So now when I'm talking about a distribution, I'm talking about you've got this S corp, you're a shareholder, and the S corp gives you, let's say, just $30,000 cash, and you're wondering, okay, well, how is that going to be taxed? I just received this $30,000 cash from this corporation. Okay, now the answer is, in terms of the tax consequences, it depends. Okay, it depends on whether this S corporation had previously been a, so remember how I said that you start out as a C corporation? Well, and then you elect the S corp status. So if you had been a C corp, and then you just immediately, so you file articles of incorporation, you create a C corp, and you immediately elect S corp status, okay? So then you would never have any earnings and profits from your days as a C corp, because you initially you immediately elected to be an S corp, okay? So if you have no prior earnings and profits, if you don't know what EMP is, check out my videos on corporate income tax. If you have no prior earnings and profits from days as a C corp, then it's fairly simple when there's a distribution to the shareholder of, let's say, $30,000. Okay, the distribution is not going to be taxed to the shareholder. Right? It's non-taxable, and I say here to the extent the shareholder's basis. Okay, so if your basis was just $10,000 and the S corp gave you $30,000, so then your basis, so let's say you have 10,000 basis, your basis would get wiped out, but you still have 20,000 beyond that. Okay, and the excess would be treated as a gain from the sale or exchange of stock, which would generally be treated as a capital gain. Okay, now if your basis, let's say, instead had been $40,000, and you get $30,000 cash from the S corp, then your basis would just go down to $10,000. Okay, so basically it's not taxable to the extent that you have basis to absorb it, and it just reduces your basis. But if you get a distribution beyond your basis, then that excess will be taxable to the shareholder. Now, it gets a little more complicated if, when initially the corporation was created, it operated as a C corp for a while and had some earnings and profits. Okay, so let's say it operated as a C corp for years, and then it had EMP. Okay, and so basically, let's say it had earnings and profits of $300,000 at the time that it filed the election to become an S corp. Okay, then you say, okay, well, now we need to track that accumulated EMP as of the time that there was an election made to be an S corp. And then we also need to track separately what are the S corp's profits going forward. Okay, this is complicated. We'll talk about it in a future video. But basically, the accumulated earnings and profits in this example would be that $300,000 at the time that you convert to an S corp. You keep track of that. Okay, you keep track of that, and then you keep track of the profits of the S corp going forward, which is this accumulated adjustments account, okay, the AAA account. Now, if there's a distribution Okay, if there's a distribution going forward, it would first come out of this accumulated adjustments account, which would be non-taxable, provided the shareholder has basis and so forth. Okay, we'll talk about that more later. And then next, you would look to accumulated earnings and profits from the old C Corp days. And to the extent there is accumulated earnings and profits, it could be taxable as a dividend to the shareholder. We'll go through that in more detail. I know that's complicated, so I hope I didn't fry your brain there. Now, how would you go about calculating the basis for a shareholder who owns stock in an S Corp? Okay, so they've got their initial basis in the stock, okay, and then so when they originally got the stock, they put up capital or whatever. So, and then if they later purchase more stock in the S Corp, right, that would increase their basis further, or if they just make a capital contribution. Also, their share of any separately and non-separately stated income. So basically, the S Corp goes and makes $100,000, and you're a 10% shareholder. Okay, so that the $10,000 then would be your share of the S Corp's income. Okay, so you're going to be taxed on that. It's going to flow through to your return, but that's also going to increase your basis, right? You paid tax on it, so now you get a higher basis, okay? So that's what I'm talking about right here with the share of income. So your share of income, your pro rata share of income is going to increase your basis in the stock. And then if there's any depletion in excess of the basis in the property, that would increase your basis in the stock. Things that would then decrease your basis. So first you do the increases and then you get to the decreases. Distributions that were not reported as income. That sounds confusing if you're saying, well, what do you mean not reported as income? Remember I was talking about with this accumulated earnings and profit, some distributions could be treated as income. So in any event, there are some examples where you could have a distribution that is treated as income. But if you just, let's say you had a basis of $40,000 and you get $30,000 cash, hey, you get a distribution, now your basis goes down to $10,000. And there's no accumulated earnings from before, anything like that, just a simple scenario. So you got a distribution that was not reported as income, right? A non-taxable distribution. That would reduce your basis in the S Corp stock. Now, also reducing your basis is your share of separately and non-separately computed losses, deductions, and non-deductible expenses. Non-deductible expenses being things like fines and penalties and stuff, which are not capital expenditures. Okay, so your share, losses, deductions, non-deductible expenses, that is going to be subtracted when calculating the shareholder's basis in the stock. So you got your initial basis and you make adjustments. Okay, your shareholder's share of income is going to increase the basis. Their share of deductions, losses is going to decrease their basis. Now, I said that with an S Corp, there's just one layer of tax, right? You don't have double taxation. That's one of the advantages. You say, hey, I get a corporation and I don't have to pay tax. I don't have the double taxation issue. However, there are some situations in which the S corporation itself could be subject to a tax, right? A lot of S corporations, this would never happen, but there is built-in gains tax, LIFO recapture tax, general business credit recapture, and a passive investment income tax. And we will talk about all these and a lot more in the videos to come.